Good morning, and happy Thursday. Welcome to the Rick Helps Real Estate live stream. This morning we're going to look at a few numbers. We're going to talk about why sellers don't have to make repairs. And let me go ahead and start out and tell you where we're at today. We got 6,388 homes on the market. Look at the 7-day moving average. We have 4,123 that came on the past 7 days, and 3807 went under contract. That's a difference of 316. So we're still kind of hanging around with this gap of about 300 homes, driven mostly by new listings coming on. You can see a little uptick there, and then sales kind of staying at about the same level before. So not a whole lot of difference going on there. Good morning from California. Hello, Mark. Interesting though, the coming soon listings have dropped by about 200 homes. That's not significant, but it's notable. So I'm going to watch that and see what's going on. A coming soon listing is, I've got one coming up next week, so it's now running as coming soon. The reason I do it is I've already got it in the system. We already established a price, but we don't have the sign up yet. I'm waiting for the photographer to come on Tuesday. So we just put it out there and say coming soon. It's going to be on its way, and somebody has already made an appointment to go view it. It's still really brisk out there. I'm going to give you a couple examples. The forbearance crisis is not going to happen. Here's the numbers for forbearances. So 23.2% of all the homes in forbearances never missed a payment. They were in there. They had the option to not make a payment, but they never missed one. 28% of people that were in the forbearance plan are now out. They've either restructured their loan, they've got a new interest rate, or they caught up on their payments. They're all done. Only 1.5% lost their home, either in a short sale or they had to sell it. So they lost their home. They had to walk away from it. That means that there was only 63,000 homes that couldn't survive it, and that's nationally. So the idea that these forbearance homes are going to turn into large foreclosures has now been debunked. Here in our market, in mid-July, our prices increased 1.4%. They were projected to rise about 3% because that's where we were clipping. So it went from 3 to 1.4 rather quickly. I started feeling it right after the 4th of July. Prices projected for the rest of the month are going to be flat, and the upward pressure eased in the past 2 months on pricing. So, but I want to stress that this does not mean that we're seeing a major slowdown, and you're going to find it easier out there going to get a house. I called on a house yesterday. It was $235,000 just by I-17 north of Glendale, and little house, looked like it definitely needed some work. Has a tenant in it. I sent a message to the agent, said, hey, you getting a lot of activity? This is the first day. 16 offers, and 6 of them are solid. So I know those offers are probably all going to be cash. A lot of them are going to be investors, and it's just out of play for the average first-time home buyer that wants to come in. So that party is not over, folks. It's still going on quite a bit. Now, speaking of investors, here we go here. Investor home purchases hit a record, surpassing the pre-pandemic levels. So it said the investors took the housing market by storm in the second quarter, buying up $49 billion worth of homes. This is nationally. The bulk of them are multifamily properties, but they're still springing back. So they went down here when the pandemic came, and they're back up. And mortgage rates 2.9 today, 2.87 yesterday. A little pressure coming up, just a little bit. But I got to tell you, we certainly didn't think we were going to be below 3% anytime soon. And you know what? If you do enough digging, you can see and you can make an argument that we might even go lower than this. Hard to understand, but anything's possible in this market. Now, here's a funny one I walked into. Where are homes selling the most above asking price? Berkeley, California. Montclair, New Jersey, Champaign, Illinois. We thought our market was hot. We're not even on this little chart here where markets are selling the most over asking price. 19%. The median list price in Berkeley is $1.2 million, and people are bidding above by 19%. Then you get to Montclair, New Jersey, and their median list price is $829, and people are coming up over $14. Champaign, Illinois, never been there. Median list price $227. That's pretty low. 13%. Utah, 10%, and a city, Olathe, Kansas, at 10%. So where are we? We're still right here, folks. 59.2% of homes, total market, are going above the list price. And then you can see here the percentage by the price category. The highest one taking the biggest hit is between 300 and 400,000. There's 1,734 homes that sold in the past month at $20,000 over asking price. Now that should start to abate in the next few weeks, but we're not seeing it or feeling it yet. So if you are thinking about listing, it's time to get serious. If I were to look and project out where I think we're going to end up based on what we're seeing in the numbers as far as the rate of decline, if you're a buyer, I think October is going to be your sweet month. If you're a seller, I think it's now. That doesn't mean you're not going to have an hard time selling your house in October. I'm just saying now is ripe. It's good. People are still knocking on your door wanting to buy your house. And in October, that looks like the trend is going down. Now, things could change, but if I look at the numbers and look at the data, even if you just look at my simple chart here, and I'll get my terrible head out of the way here. As long as there's a 300 to 500 unit gap on a weekly basis, and you just extrapolate that out over a few months, you're back to normal in November. So it doesn't take much. It doesn't take much at all. LendingTree ranked the most popular metros for millennial buyers. This is the surprising one I ran into. Share of mortgage requests from millennials, 61.79% in San Jose. Now, people in Phoenix are complaining that it's unaffordable, it's terrible, it's awful. But yet the number one spot is San Jose. But that's because a lot of these millennials are working in the tech industry and they can afford it up there. The average down payment for millennials, $158,000. Average requested loan amount among millennials, $704,000. Holy cow. And then look at number 2 is Boston. Average down payment, $78,000. Loan amount, $416,000. Then number 3 is Denver. And where do we sit? We're at the bottom. Can you believe it? Least popular metros for millennial buyers is Las Vegas, Tampa, Florida, and Phoenix. The share of mortgage requested from millennials is 46.3%. The average down payment is $35,000. The average requested loan amount is $258,000. That's why you hear people say that Phoenix is affordable when you compare it to the other places like San Jose. I mean, I don't know how they do it up there, those kids, man. But this is the largest buying group that's out there in real estate right now. So, they're the ones that are buying, and they are not coming to Phoenix. They are going to other areas. Now, Boston, I understand, it's fun, but it's cold. It snows out there. I'm looking at some homes on the market that I can see are overpriced, and those guys are going to start hitting reality, and the prices are going to have to come down. I've got one that's near me that's already been on the market for 3 weeks. It doesn't take rocket science to tell you that that price is too high. But sellers still have such an advantage that when you inspect the house and you ask for repairs, they can still dig in their heels and go, no, I've got 2 other offers behind you. I'm not fixing all that stuff. Sellers are still going to be that way. So don't think when you see that these numbers are declining that they aren't in the driver's seat still. So there's been more and more of a trend just to sell houses as is, because quite simply they don't have to fix them, and a lot of it's just little stuff. Now, when you get into bigger discussions of a bad roof or a bad AC unit, as a rule, they're not walking away from that. They are willing to negotiate to a certain degree, maybe split the cost at close of escrow, but just be prepared when you're buying right now, because the market is still strong. It's weakening, but it's still strong. Buyers are just not in the situation where they have to agree to the list of repairs that you're giving them. Now, I've seen buyers that the list comes, it's almost a 28 to 35 page document, and they say, I want everything fixed. Well, you're killing the deal if you do that now. When you get that report, you need to look at it and say, seriously, what are some of the things on here that I can fix? Sometimes it's just light switches, it's outlets, it's a new breaker, it's simple stuff that you're going to end up doing anyway as you own the house over the course of time. Granted, you can't slap on a new roof or replace the AC, but when you go through that list of the little things that the inspector will call maintenance items, just put those off to the side, because you're not going to be able to get the seller to agree to repair those items. And sellers, as time goes by now, you're going to have to learn to be a little more flexible on the major repairs, because you don't want to be stuck holding on to your house because you didn't agree to fix something or negotiate, for example, a new roof or a bad AC unit. So your window's kind of short. We could be in a strong seller's market even well into next year, but right now it's looking, by the time we get to Christmas, that might not be the case. So I really don't know where it's going to end up. But for you buyers, when you're out there and you're trying to negotiate a deal with these sellers and you get that large report, you're going to kill the deal. If you ask for a lot of repairs, you're going to kill the deal. Now, the market right now, if I were to look at just the index, and let me pull this up here for you. It's showing that our supply is just barely coming up here, but it's coming up at a fairly consistent clip. This is an index with 100 being normal, right? So right back here, this was in May of 07, September of 06. Look at that supply that we had there. And the market in general is coming down. So in other words, the demand and the supply shows the index dropping to 404. But this is considered a balanced market down here. But when you look at the data, this is coming down so steep now that it mirrors 2005. That's why we're saying that by November, we should be down here. Demand is dropping, but it's still above what we consider a balanced market. But when you take the demand and then you look at the supply, the gap between the two is just going to force prices higher. However, this past month, we didn't go up 3%, we went up 1.3%. So that's hope. So don't expect to get the house at the asking price. In most cases, if you're out looking to buy, look at something that's been on the market at least 2 weeks. That's your great opportunity. If they've been on the market 2 weeks, they're asking too much for the home. So lower that price and get that offer. Sellers, if you're on the home for 2 weeks, you've made a mistake. It's time to pull back. So because it's not going to be you've gone from a month that had a clip of 3.5% of price appreciation to a few weeks where it dropped to 1.2. That's a huge light bulb moment for you. So if you're still priced too high and you're on the market for 2 weeks, if you're serious about selling your home, lower the price and get it off the market, because it's not going to get better anytime soon. Now, having said that, everybody take on the day. Have a fantastic Thursday. See you tomorrow.